Everybody, welcome to today's fundamentals. Hello, Peter.
Hello.
A new day, a new week. What's up in the markets?
Well, we had the US dollar, which started the week on the front foot. Practically, the USD had some support from Friday afternoon as we got the US PPI rates, which, on a year-on-year level, they slowed down, but not as much as the market expected, which more or less tended to imply that there are still inflationary pressures within the US economy at the producers level. That would be one. The second element was we had the preliminary University of Michigan consumer sentiment. That was for December. It was better than expected, and it implied that overall the morale among consumers in the US was better than expected, so that could lead to higher retail sales, especially given that we are already in the Christmas period. Yeah, that was the main beginning.
And what's up on the commodities front?
There seems to be some hesitation in the oil market. There was a move higher for oil prices, for WTI prices. We have to note here, we have mentioned it in our written reports on Friday, but a key pipeline running from Canada to the US was shut down due to an oil spill in Kansas. And that seems to be causing some hesitation for oil bears. So practically, we may be seeing oil prices stabilizing somewhat. Overall, for the time being, though, bearish tendencies are still present and could take over oil's price at any given moment. But for the time being, we note that oil prices seem to have stabilized a little bit.
And what's on the calendar for today?
Well, we already had the release of UK's GDP rate, that was for October, and the manufacturing output growth rate. Both accelerated beyond market expectations and tended to provide some support for the pound. I would be noting that practically the next releases would be in the Asian session tomorrow, when we get from Australia the business conditions and business optimism from Australia. Should we see better readings, we may see the Aussie getting some support. On the monetary front, I would note that we get from Canada BOC Governor Tiff McClellan. He will be speaking. Should he sound a little bit dovish, we may see the CAD weakening somewhat.
And how about the rest of the week?
It's going to be a busy week ahead. We're going to be getting a number of high-impact financial releases, as well as monetary policy events which could affect the markets. I would make a start with the key event for the week. That would be the Fed's interest rate decision on Wednesday. The bank is expected to hike rates by 50 basis points. I would say that should the bank actually hike by 50 basis points, the next big question would be the accompanying statement. And we may see the Fed keeping a rather hawkish tone, implying that it will keep high rates for a prolonged period of time in order to curb inflationary pressures. And that could provide some substantial support for the US dollar. I would also be noting the new dot plot. Should Fed policymakers, as is our expectation, actually show that they expect rates to increase more than what was expected in the September dot plot, and most probably they will be superseding 5%, then we may see the USD getting some support, as practically the Fed policymakers will be setting a new bar, a higher bar. And overall, I would expect, despite the smaller rate increase in comparison to the last one, we may see the Fed's hawkishness actually providing some support for the US dollar. I would also be noting on the monetary front, we get BOE's interest rate decision. The bank is also expected to hike rates by 50 basis points. Should that be the case, and should that be also accompanied by a hawkish accompanying statement, we may see the pound getting some support. There is a catch here. And the catch is that in the last interest rate decision, two policymakers, two members of the Monetary Policy Committee, practically descended on the size of the hike. 75 basis points rate hike was decided. Those two, the one was preferring a 50 basis points rate hike, and the second a 25 basis points rate hike. So we see that there is slowly but steadily a shift in the balance of power within Bank of England. And that may force the bank to actually lower the tones regarding the hawkish comments it will include in their combining statement. Such a development could cause pound bulls to hesitate somewhat. And I would also be highlighting, also on Thursday, ECB's interest rate decision. The bank is expected to hike rates by 50 basis points. I have to note here that there's some ambiguity about the size of the rate hike. The market is, according to EuroOIS, in the majority implying or pricing in that the bank will proceed with a 50 basis points rate hike. There is, though, an increasing minority which tends to imply that a 75 basis points rate hike is also possible. So we may see some disappointment should the bank actually proceed with a 50 basis points rate hike only. There is another element, though, of ECB's interest rate decision which is expected to generate substantial interest, and that would be the terms of quantitative tightening, which the bank is expected to set out in its meeting on Thursday, and is expected to be more or less a second way of tightening the monetary policy. So should that be more on the aggressive side, we may see the euro getting some support. Also on Thursday, we're noting from Switzerland SNB's interest rate decision, and from Norway we get Norges Bank's interest rate decisions, which could also generate some interest for their respective currencies. As for financial releases, I would be making a start on Tuesday. We're getting from the US the CPI rates, both on a month-on-month and on a year-on-year level. The rates are expected to slow down and may more or less prepare the market, if actually so, for a less hawkish Fed. So it's important to see the timeline here, that we get the US CPI rates on Tuesday, the Fed's interest rate decision on Wednesday, and all of that is going to be followed, if I'm correct, on Thursday with the US retail sales growth rate. So we're getting financial releases throughout the days from Tuesday up until Friday. Also from the US, I would be noting the weekly initial jobless claims figure and the Philly Fed Business Index. Now, from the pounds side, I would be noting that we're getting tomorrow UK's employment data for October, which I expected to be not that good. On Wednesday, we get the CPI rates of the UK. And on Friday, we note two releases. The first would be UK's retail sales growth rate and the services PMI figure. It's the preliminary release. It's expected to drop deeper below 50, slightly, but still. And that would imply practically a wider contraction of economic activity for the substantial sector of the services. And last but not least, the euro. We're getting the preliminary PMI figures. I think that will be the most moving financial release of the week for euro traders on Friday. Now we're getting some conflicting messages here. The heavyweight, though, is still on the German manufacturing sector. Should that drop, that could be having an adverse effect on the euro somewhat. Other than that, I would be noting also from Australia the employment data on Wednesday. Yet I would say that more or less they seem to be remaining rather solid and could provide some support for the Aussie, despite a correction lower of the employment change figure.
Any final comments?
It's going to be interesting how the market prepares for the Fed's interest rate decision on Wednesday and the US CPI rates tomorrow. We may see the market more or less keeping a wait-and-see position, and then start repositioning itself. And we may see ripple effects from the releases being not only in the FX market, but definitely also in the stock markets. Should the Fed maintain a rather hawkish stance, we may see US stock markets weakening.
Great. Thank you, Peter, for your time. And everyone for watching. Join us after a short break for technical analysis with Peter Yosef.
Welcome to the technical analysis part of the presentation. My name is Peter Yosef, Senior Market Analyst at IronFX. Now, in front of your screens, you have the US dollar index for our chart. I already started working on it. And mind you that all charts to be presented are to be of the same time frame, the 4-hour time frame, unless otherwise stated. Now we see that the US dollar index had a sideways motion, maintained a sideways motion. That's practically since Thursday when it dropped. And despite some support, some very slight support, I would note that more or less the price action remained rather stable. Let's correct though the resistance support lines, making a start with the first resistance line, which is now being placed at 105.55. And the first support line being placed at 104.0. Yep. 104.5, sorry. I would like to have a look at, we can see that the resistance lines are still valid. This peak here, peak I'm holding the R2. And the R3 is being placed here. And this has to be turned on to support line. Let's have a look where the S2 is now being standing. It's actually pretty valid, pretty wide. Seems good. At 102.50 in green. Okay, it will not be, definitely not be symmetrical, but who cares at this point? Okay, let's rearrange. Okay, let's keep that. Let's do the corrections also on the labels. $102.50. 101.30 stands. S1 now being placed at 104.5. S1 sorry, R1 at 105.55. $107.15 being the second resistance line. And final one at 109.10. It's a little bit off, I know it. It's definitely disproportional, but actual symmetry right now is not one of my main priorities. Just want them to rest on peaks and troughs. So for the time being, we tend to maintain a bias for a sideways motion. The sideways motion could be maintained between the 105.55 resistance line, which practically marks a peak here, and the 104.55, a true here. Mind you that the R1 was also tested here, here, and here. So it seems to be pretty valid. I'm keeping that. Should for any given reason the price action of the US dollar index break any of the pre-mentioned levels, either the R1 or the S1, then automatically, practically, we're about or more inclined to switch outlooks. And should the price action break the R1, then that would imply practically that a bullish outlook starts to emerge. I would expect the price action for the bulls to have its next stop at the 107.15 resistance line. Why? Because we have beautiful resistance levels here, here, here. There are four of them, so that seems to be pretty valid. But I wouldn't be surprised to see the R2 also be broken should the price action be intense enough. On the flip side, should the bears take over, we may see the price action dropping, breaking the 105.05, and the pair start aiming, if not even reaching, the 102.50. Beautiful chart. Let's move now to Euro USD. Some slight readjustment. Actually not. It's a very tight range bound movement, but it's holding on between the 1.0605 resistance line and the 1.0460. Actually, the range bound movement has narrowed even further. So we tend to maintain our bias for the sideways motion to continue. There is a slight catch here. The RSI indicator, which has risen slightly. It's currently at 57.50. So there may be some slight bullish tendencies here. However, that would be also a reflection of this green candlestick here, going to be today's early European session. Nevertheless, should the bulls take over, mind you that our base scenario for now is that the sideways motion is to continue between the R1 and this one. But should the bulls take over, we may see the price action breaking the R1, 1.0605, and start aiming for the 1.0785. On the flip side, should the bears take over, we may see the price action dropping, breaking the 1.0460, and start aiming for the 1.0295. Let's have a look at GBP USD. Also in a sideways motion. Let me clear this up. Okay. Also practically narrowing its range bound motion over the past 48 hours. So I would expect it to maintain this direction for the time being. Note also how the Bollinger Bands have narrowed. Once again, though, we see that the RSI indicator jumped a little bit higher, yet it's correcting slightly but steadily lower. It's at 57.8, so there may be some bullish tendencies, very slight bullish tendencies in the pair. But for the time being, once again, a sideways direction would be advisable given that we had this already for the past, let's have a look, how long has it been? 5 days? Oh, since the 1st of December, for 12 days now. Okay. Now let's should the bulls take over. say for example the US dollar weakens or the pound gets some support, we may see the price action breaking above the 1.2345 and start aiming for the 1.2660. On the flip side, should the bears be in charge, we may see the price action reversing direction, breaking the S1 1.2125 and start aiming for the 1.19. By the way, there was a release during today's early European session. We had UK's GDP rates and manufacturing output, among other data. And it was interestingly enough that both the GDP rates as well as the manufacturing output for October both accelerated more than expected, providing some slight support for the pound. It would be interesting to see the market reaction at the moment of the release. So allow me to drill down to the minute chart. Let's widen this. And it was at 9 o'clock my time. Here it is. You can see the spike, which was at around 29 pips, maybe even 30. Decent move actually. But you can see that afterwards how pair started to rise, forming higher peaks, higher troughs. It seems to have started to stabilize as the effect of the release has wears off. Okay. There was still some market reaction, but nothing impressive. Let's drill back to the 4-hour chart. Rearrange the pair. Once again, sideways motion expected. Should the bulls take over, a breaking of the 1.2345 should be expected, and the price action may start aiming for the 1.2660. On the flip side, should the bears take over, say for example, should the US dollar strengthen, we may see the price action reversing direction, breaking the 1.2125 and start aiming for the 1.19. Another element which was correctly noted by our viewers, and I should have mentioned it, my bad. See the extension of the upward trend line. It's about to be tested once again. Now, should that be broken, the upward trend line, I mean, that would be another indication for the sideways movement. And given the low volatility which is characterizing the pair, I think that most probably it will be broken. Okay, let's move now to USD/JPY. USD/JPY, which maintained its sideways motion since last Thursday between the 137.50 and the 135.80. We tend to maintain our bias for the sideways motion to continue, especially given that the downward trend line seems about to be broken, if it hasn't been broken already. I would say that it did. So for the time being, we tend to maintain our bias for the sideways motion to continue. It's a very narrow channel within the price action is moving. We're talking about 170 pips, not more. So it could be broken at any moment. And should the US dollar be on the rise, we may see USD/JPY rising along with it, breaking the 137.50 and start aiming for the 139.65. Note how the level marks a peak here and here. While on the flip side, should the US dollar weaken, we may see the price action dropping, breaking below the 135.80, which provided support here and resistance here, and start aiming for the 133.90, which provided substantial support actually right here. Okay, let's have a look at the second safe haven currency pair. That would be USD/CHF. In my opinion, what we are seeing right here is a very, very slightly different picture. Okay, the sideways motion is still valid. Why? Because the S1 seems to be holding its ground. it was correctly placed and it actually shows its support for the pairs price action. Yet, in contrast to USD/JPY, which was more balanced, I would say between the 137.50 and 135.80, the USD/CHF seems to be having some slight bearish tendencies given that it constantly is testing the S1. So we may see the bears taking over, breaking the S1, and in which case we may see the price action start aiming for 0.9210. Let's have a look how far back that actually goes. That would be another interesting question. Oh, it goes back up until March. Let's have a look. Yep, up until the last day of March. It was the last day where this level was tested. Okay. It has hit the S1 exactly once again. I would require, though, a clear breaking of the S1 in order for me to actually reverse my bias for sideways motion in favor of bearish outlook. Now, the possibility of a bullish outlook does not seem exactly probable, but it's still a possibility and should be covered. Now, for a bullish outlook, we would require definitely a breaking of the R1, 0.9450, which provided resistance here, here, and in which case we may see the price action ascending and start aiming for 0.96 resistance level. Mind you, we may have a mid-level at this peak here. That would be at around the 0.9540. In my opinion, though, I think the way after the 1 is cleared for the pair to ascend to the R2 0.96. For the time being, though, once again, as long as there is no clear break of either the R1 or the S1, the sideways motion is being maintained. On the other hand, though, a clear warning is also being issued here for bearish tendencies, and we may see the price action breaking clearly the 0.9330, the S1, and start aiming for 0.9210. Let's have a look at the Aussie commodity currency pair AUD/USD. Oh, there's an interesting fight here. On the one hand, the price action was pushed upwards from the upward trend line, but on the flip side, we can see that the 0.6795 is largely holding its ground. So for the time being, I would expect to see a stabilization, but once again, like USD/CHF, only in the reverse, we are seeing bullish tendencies as the price action is constantly testing the R1. So for the time being, we tend to maintain a bias for a sideways motion, practically just below the 0.6795 resistance line. But once again, I wouldn't be surprised to see the pair's price action ultimately being able to break above the R1 and start aiming for the R2 0.6915. Mind you that the R1 is holding its ground over the past 2 days, but it also provided support back here that would be mid of November. So it's a pretty valid level. Now, in the case we see the bears taking over, which once again is a possibility, would require clear breaking of the S1, 0.6640, and the price action to start aiming for 0.6545. Okay, let's move now to USD CAD. Excuse me. Despite the upward movement, which was characterizing the pair for the past 24, 48 hours, let's have a look. Since That would be the 9th of December. That was on Friday, the early Asian session, the European session, and the American session. We see that the pair is unable to break above the R1 1.3685. Actually, it wasn't even able to reach it. It reached it in the past 24 hours only once, and that was during the European session on Friday. So, as long as the price action does not break above the R1, we maintain our bias for a sideways motion between the R1 and the S1. In that case, we may see the price action rising even further or even remaining stable at the current levels and start slowly but steadily dropping, aiming for the S1 1.3570. Yet that should be respected as well. And once again, on the other hand, we note that there is low volatility for the pair. So that would be implying practically that the stabilization may be at an even tighter range bound movement. On the flip side, should the bulls take over, I would expect the price action to break clearly the R1 and start aiming for the R2 1.3805. Mind you that the R2 provided resistance here and here. On the flip side, should the bears take over, I would expect the price action to drop, reach the S1, break the S1, which provided support here and here, and resistance here, and start aiming for the 1.3395 all the way down. A little bit extreme scenario, but still a possible one. Let's not forget the bearish movement of the pair here, when within 24 hours the pair practically moved by 287 pips. So it's a movement which may not be probable, but it's still a possible one. Let's move now to the Kiwi and the DUSD. Mind you that during late American, early Asian session tomorrow, we're getting New Zealand's trade data, and definitely we have to make some readjustments here. On the upside and a little bit on the downside. The movement has proven that the levels need to be a little bit recalibrated. We'll be placing the R1 here, and that would be the 0.6440 and the S1 a little bit higher. In order to describe better the sideways motion of the pair, and that would be at the 0.63 exactly. Okay, let's go hunting for a new resistance line. Definitely this is a keeper and this is a keeper. So the S1, S2, S3 are being set. Let's also change the label by 10 pips at 0.63 and also place the R1 at 0.6440. Let's loosen up the pair's movement, the chart, and let's start searching for a new ultimate resistance line. Okay, definitely this one is a keeper, and it's the 0.6570 with the next peak could be here, could be high as well though. I'm keeping this peak. It's pretty narrow, no, but still it's pretty valid. Note how it beautifully reversed the upward motion of the pair, and that was on the... cancel that. on the 26th of April. Now there were higher peaks further back, like this one, and this one, but I think this one is a fresher one and could be valid. Okay, that would be the 0.6645. Let's readjust. 0.6570 is the second resistance line. I'm placing another one, albeit it should be most probably a mid-level, but for testing purposes for the time being, I'm going to be holding it. And it's the R3 0.6645. A level which we would have to recheck at a later date. For the time being, the sideways motion is being expected to be maintained, and that goes as long as the price action of NZD/USD remains between the R1 and the S1. Should the bulls take over, we may see the price action rising, breaking the R1, and start aiming for 0.6570. On the flip side, should the bears take over, we may see the price action of NZD/USD dropping, breaking the S1, and start aiming for the S2 0.6155. Okay, let's have a look also at gold. We haven't checked out gold for a long time now. Hasn't moved much, did it? Okay, there's definitely a wide sideways motion here. I'm readjusting the S2 level practically at 1765. Could be 66. Yep, that's better. I'm also keeping the 1785, but not as a resistance line, more as a support line, as the price action has moved above it and has tested it. Definitely we're going to be needing a new ultimate resistance line, and we may have to go further back. These peaks here are beautiful. Something like this. Yep, I'm keeping that. And that's the, in red please, it's a resistance line. The 1875. Okay, that should be it. Let's readjust. Let's work the labels. S3 now being placed at 1735. S2 being placed at 1766. S1 at 1785. R1, which is being marked at the peak here and this peak here as well, would be the 1807. R2 being placed at 1840. 1875. That's it. For the time being, we tend to maintain a bias for the sideways motion to continue between the R1 and the S1. Now, for our sideways motion bias to change in favor of bearish outlook, I would require a clear breaking of the S1 1785, practically a lower show than this one. So it would have to drop, break the S1, possibly breaking also the S2 node that shows here, and start aiming for 1735. On the other hand, should the bulls take over, we may see the price actually rising, breaking the 1807, and start aiming for the 1840. I would like to have a look also at US stock markets. Let's have a look at the Dow Jones. Now the Dow Jones has some slight bearish tendencies, but overall the price action bounced beautifully on the S1 33,470 and was not able to break it. So we tend to maintain our bias for the sideways motion to continue. Nevertheless, should the bears take over more decisively, we may see the price action dropping, breaking this one, and start aiming clearly for the S2 32,670. I know that it's maybe seemingly a little bit wide, but mind you that the price action of Dow Jones was able to cover the distance within a day easily in the past. Let me just show you this one, or this one to the upside. On the other hand, should the bulls take over, I would expect the price action to rise, break the R1, and start aiming for the 35,500. Now, I know that lots of you guys have been reading for a possible rally of US stock markets for the time being, at least on technical level, and according to Dow Jones, that's not being supported. The markets seem to be keeping a wait and see position, and I think that's being reflected also on the price action. Definitely this is out of the question. Okay, let's have a look also at WTI. A quick look before we finish. That's interesting. Now definitely we have to switch the 72.35 55 support line into resistance line, given that the price action has moved decisively lower. So the S1 switches its role and becomes now a resistance line. Let's go hunting for a new ultimate support line. All the way down, up until here. And that would be the, in green, 62.35. Readjusting the chart. Let's correct the labels. Now we note that there are still some bearish tendencies here for oil's price. Given that we have also an RSI indicator which is pretty low. It's currently at the reading of 33. So I wouldn't be surprised to see the best taking over. But for a bearish scenario, I would require a clear breaking of the S1 and the price action to start aiming for the S2. The R2, which is now being placed at 75.40. The R1 used to be a support line. Now it's a resistance line at 72.55. The S1 at 69.25. The S2 at 66 exactly. And the S3 at 62.35. Let's recheck that. Yep, 62.35, correct. Locking everything in. So, for the time being, the base scenario is for a sideways motion. Why? Because the pair was bouncing yet was moving in a sideways motion for the past 24 to 48 hours. It's characteristic that the downward trend line guiding the commodities price has been broken. On the flip side, though, we note that despite a rise during today's opening in the Asian session, during the European session, WTI's prices relented any gains made, and the RSI indicator is pretty low. And that would be implying some bearish sentiment in the market. Now, for us to switch our bias in favor of for us to switch our bias for a sideways motion in favor of a bearish outlook, we would require the commodities price to drop, break the S1, 69.25, and start aiming for the 66 support line. On the flip side, should the bulls take over, we may see the price action reversing direction, breaking the 72.55, and start aiming for 75.40 resistance level. A level which provides resistance here and support here. So it's pretty valid. That should be it from all of us here at IronFX. Best wishes for solid trading.
Everyone, my name is Emily and welcome to another educational video. The word Goldilocks is a reference to the popular children's story Goldilocks and the Three Bears. The term is used in finance to describe an economy that is just right with steady growth and normal inflation. It is an ideal economy that is not too hot and not too cold. In other words, it is a Goldilocks economy. In this balanced and healthy economic system, there is full employment, economic stability, and steady growth. The economy is not expanding too much to push inflation too high, and not slowing down to enter into recession. A Goldilocks economy is also good for investing and trading. In a growing economy, companies also grow and generate positive earnings, resulting in their shares performing well. Goldilocks economies are temporary in nature because there are boom and bust cycles. While there may be disagreement among economists about what the exact characteristics of a Goldilocks economy are, the basic idea is that there is a balance between growth, employment, and inflation. The ideal conditions for a Goldilocks economy are low unemployment. Unemployment is measured with the unemployment rate, which reflects the number of people willing and able to work but unable to find gainful employment and who have sought work in the past 4 weeks. The Federal Reserve estimates a normal rate to fall between 5% and 6.7%. Another condition for a Goldilocks economy is asset price inflation, which refers to an increase in prices of shares, real estate, derivatives, bonds, and other assets. Low market interest rates and low inflation are also important, as well as a steady gross domestic product. The GDP is the most essential indicator for a Goldilocks economy, as it measures the value of all services and goods produced in a country and reflects the health of an economy. For example, a negative GDP in 2 consecutive quarters indicates a recession. On the other hand, a sharp increase in GDP can push prices too high and result in high inflation. An example of the Goldilocks economy is the US economy of the middle to the late 90s, but also the US economy after the bursting of the dot-com bubble between 2004 and 2005. Thank you so much for joining us today, guys. See you soon. Bye-bye.
Hi, good evening. Let me just check the chat settings. Let me share my screen. All right, so hi guys. Just want to check if you guys can see my screen. If you can type it in the chat box that you are able to see. Are you guys able to hear me and see the screen? I will need someone to respond before I can start sharing today's webinar. See someone raised your hand. If you have any questions, do type it in the chat box. It's a bit hard for us to catch that function. Okay, I'm assuming the screen is actually sharing fine. You guys can hear me perfectly. Okay, so a little self-introduction. We are bringing you the webinar from the Everest Fortune Group, and we are also the best finalists for Best FX Research for 2019, 2020, 2021, and also Best Equity Research in 2020 and 2021. Okay, so today's agenda will be on risk management and on leverage. So it's a pretty lengthy chapter, this webinar. If we have any extra time left, I'll be doing some live analysis for you guys, and then we can better see today's Hi, good evening. Let me just check the chat settings. Let me share my screen. All right, so hi guys. Just want to check if you guys can see my screen. If you can type it in the chat box that you are able to see. Are you guys able to hear me and see the screen? I will need someone to respond before I can start sharing today's webinar. See someone raised your hand. If you have any questions, do type it in the chat box. It's a bit hard for us to catch that function. Okay, I'm assuming the screen is actually sharing fine. You guys can hear me perfectly. Okay, so a little self-introduction. We are bringing you the webinar from the Everest Fortune Group, and we are also the best finalists for Best FX Research for 2019, 2020, 2021, and also Best Equity Research in 2020 and 2021. Okay, so today's agenda will be on risk management and on leverage. So it's a pretty lengthy chapter, this webinar. If we have any extra time left, I'll be doing some live analysis for you guys, and then we can better see today's chapter on risk management and also what does risk and reward ratio actually really mean. So what is risk management? So risk management is basically a set of rules that governs the trader's actions to protect against the downside of the trade. So many of you might know there's something called stop loss, and as well as a stop loss margin that we are looking at. And then on the second point, since every trader will experience a loss or a series of losses at some point, proper risk management is actually essential for long-term trading success. Okay. So risk is the opposite to reward. I mean, that's very simple. Okay, I will need everyone to actually mute and close off your videos. Okay, if you have any questions, you guys can actually type it in the chat box. All right. Okay, so at which point will your analysis be considered incorrect? So this is where we consider when do we, or what price, at what point that we put in our stop loss, and how much would you lose at that point of time. Have you guys calculated what kind of percentage of risk reward ratio you guys are putting yourself into once you enter upon your analysis, and the appropriate size for your trade. Tools for effective risk management. Okay, there's 3 types of rules that traders can follow through. One of which will be leverage and margin. Second will be stop loss and take profit. And lastly will be risk to reward ratios, which is the one that I have been talking about. Okay, so first up, we can talk about leverage. So just want to know by a show of hands or a type of yes in the chat box, how many of you actually leverages through and actually knows well enough about the concept of leveraging? Okay, I'm assuming everyone's still pretty new on the concept on leveraging. So let's take a look. So basically, leverage is the ability to control a large amount of money using a very little amount of your own. All right, enter in a position that is more valuable than the amount of money you have in your account. Sounds like a pretty good concept, but it's also a very hard concept to actually grab, right? So leverage is a double-edged sword. So for example, right now you are looking at a capital amount of $10,000. Let's look at the first leverage ratio of 1:20. So you're able to control a position of 200,000, which that will allow you to have a maximum trade size of 2 standard lots. And every 10 pip move, you'll profit in $200 in your capital. Looking at the second leverage ratio, we are looking at 1:100. So you're able to control the position of 1 million, all right, with a capital amount of $10,000, which allows you to have a maximum trade size of about 10 standard lots. So with every 10 pip movement, you'll get $1,000 back in profit. And then lastly, we are looking into a 1:500 ratio, looking at a 5 million controlling of a position, and that gives you to the amount of 50 standard lots, looking at a $5,000 reward at every 10 pip movement in your direction of your analysis. However, we are now going to look at the losses that could incur from the leverage movement. So back to the first kind of leverage ratio at 1:20, we are looking at 2 standard lots. With every 10 pip, your losses will go to $200. So basically, it is the same as the amount of money they will gain if it works out according to analysis. And then we are looking at the losses as well. So for example, you take the last ratio, the last leverage ratio, 1:500, giving you a controlling of a position of 5 million. 50 standard lots. So every 10 pip will cost you to lose $5,000, right? So that will actually take an impact on your capital amount, just by that's as equal as 50%. So leveraging might sound great if you are all winning or profiting and your analysis just so happen to work out fine. However, if you are losing, you could lose your account to a margin call really, really fast. So let's look at margin right now. So margin is the amount of money that trader need to put forward to open a trade, and then margin level equals to equity divided by use margin times 100 for percentage. So for example, we can take a look right here. If you're using the ratio of 1:100 leverage ratio, use a margin percentage of 0.01 equals to 1%. So buying 100,000 euros with a current price of 1.04 USD with a 1% margin, your required margin would be at 1.4K. Margin level equals to 10,000 divided by 1.4K times 100, that will be 714%. So I did mention about margin call just now when we were talking about the losing of a profit. So you can see that margin call level is when the margin falls to 100% and unable to open for any more trades. And margin call equity falls below 100% of the margin required, you will have to deposit more cash to sustain the position. If not, the position will automatically close out. So let's just say talking about stop out. So free margin falls below 50% of the margin required, positions will close out automatically. So how much risk should we actually allocate to a trade that we deem worthy or we want to look at? So before I move on with this topic, is there any questions on the content that I have shared before this slide? Okay, so I guess we're all good. Let's look at risk allocation. So risk allocation actually basically means risk per trade should always be smaller percentage of your total capital. So for example, you are putting 2,000 out of your 500,000 kind of trade. So you're looking at a very small percentage of your total capital. So typically the maximum loss should be allowable no more than 2%, right? 2% is a good gauge. I mean, there are many different kind of risk takers, right? We have the very, very safe kind. We have adverse risk takers. So we are looking at normally when we advise, when we are sharing this kind of risk allocation content, we will normally tell our attendees that maximum loss shouldn't be allowable more than 2%. All right, that also depends on your experience level and trading style. So in comparison to a $10,000 account, we are looking at one trade for $200 that will equals to 2% risk and 5% risk at 500. So we are looking at a series of numbers of trades. We have 2, 3, 4, 5. So if let's just say if you are putting your account at maximum of a 2% risk and you take 5 trades, and that will amount to $961 out of your $10,000 account, coming up to about 10% of your account. And then if you're taking a 5% risk per trade, then we will be looking at $2,262 after all these 5 trades technically have lost, or we are risking the amount at a 23% mark. So what is the ideal percentage per trade? All right, so I mean, it would be great if you guys can pitch in and tell me how many percent do you guys actually normally risk per trade? Or you guys can look at these numbers on these slides and give a gauge. We are looking at 1 to 3%, 5%, and 10%. So what is your ideal risk appetite? Okay, so I have most common answers at 1 to 3%. I think 1 to 3% should be relatively safe, but so what is the ideal one that we are looking at? So for example, you have $1,000 and we are looking at a roulette here. Bet on the black to win, there's about 48% chance to win. So how much would you bet? It's a very simple math gambling question, right? So let's just say we are betting on black and you have 48% chance to win. How much would you bet it? Basically, the more you bet on it, the more you would lose. It's a simple math. So even though the percentage of winning is at 48%, which is pretty high for out of 100%, however, the more you bet, the higher chance and the higher risk you are taking in terms of this roulette, for example. And then let's just say, in this case, sorry, I think there's a typo on the slide. So in this case, if you are betting on red, So how much would you bet? So you see, it is the same concept, however, with a lower probability of winning. However, the amount of money you're putting in will increase the risk because of the lower probability. So how many pips should your stop loss and take profit be? So I know that this can be super subjective. Certain people look at the pips, certain people look at the horizontal support and resistance level. All right, so we are looking at how many pips per se. So I mean, if you guys have exact how many pips you guys actually follow through while you are trading, you guys can type it in the chat box below. However, I feel that there are many other ways to look at it, not just pips. So if we have time for the live analysis later on, we will look at how are the other ways of putting in your take profit and stop loss. So we also have to understand risk. So understanding risk and what is your ideal lot size. We have 0.1, 0.3, and 1. So how does lot size affect your stop loss? How does lot size affect your stop loss? So we are looking at the graph here. Account size at 50,000 USD. Currency pair looking at Kiwi dollar. 1% of the account at 500, 2% of the account at 1,000, and 3% of the account at 1.5K. So we are looking at a stop loss of 50 pips, and we are looking at a take profit of 90 pips. Okay, so in this case, the lot size do affect your stop loss. For example, you are looking at putting a stop loss at 50 pips away. However, your lot size is in a huge amount, a huge lot size. For example, you are looking at 1 standard lot, right? If you are losing all the way at 50 pips, that will allow you to might get into margin call. All right, so lot size do affect your stop loss. All right, however, if you guys are more keen on looking at pips instead of a how do I put it, capital margin level, so do calculate against your lot size. So for example, if you're looking at 50 pips stop loss, use that to backwards calculate to your account and what is the appropriate lot size for you to enter for this trade. So we can also take a look at the pips, right? So let's look at 50 and 90 pips. In this case, you will see that, 50 against 90 pips looks like a very big risk and reward, right? So let's look at the next slide. We're looking at 20 and 36 pips. Yes, it looks like lesser pips, looks like a lesser, more safe kind of trade. However, they are the same. All right, they are the same if your lot size is the same. It's because the risk to reward ratio is the same, right? So if your lot size is according to pips, then this will be safer. However, if you are comparing risk to reward ratio in terms of percentage, they are the same. All right, so this is one tricky thing that sometimes people are not reacting to the number of lot size. Sometimes people are not considering the risk to reward ratio when they're entering the lot size, as well as looking at an effective stop loss. Yeah, so you can see that there's two taglines here. It's not about the number of pips you make, it's about the risk to reward of your trade. So look at the ratio. I think risk to reward ratio is really very important in this case. So for those that are wondering how we got the pips, you can look at the entry price on the left, on the right, okay? So stop loss and take profit placement. So where is the appropriate place, appropriate price that you guys technically should look at during your analysis? All right, so first point would be, rather than considering stop loss and take profit levels as fixed pips amount, stop loss and take profit levels should be placed on technical levels on the charts, right? Some traders are super fixated on the idea of, I will only put my stop loss at, for example, 15 pips, 20 pips, and I will not take it beyond that. But how sometimes putting stop loss according to pips might affect your analysis in terms of you're not allowing your analysis to have breathing space, you're not allowing the market to correct to your analysis, you're not allowing the market or the price to actually move as per what you're looking at. Okay, so instead of looking at a pip level or pip amounts, stop loss and take profit should be placed on technical levels on the charts, which is also our important horizontal levels like your support and resistance and historical price values. All right, so one of the example will be shown in this chart below. So stop loss beyond and take profit before. So normally stop loss will give it beyond the resistance or slightly above the resistance or the support, depending on the direction you guys are looking at. And take profit will normally try to put it slightly before what we are looking at, slightly before the resistance that we are aiming to target to, and slightly before the support we are aiming to target to, which actually allows our analysis to be able to follow through and take profit and stop loss when it is absolutely necessary. All right, so one of the example is shown here. In this case, they are looking at a sell, right, from the major resistance area on the yellow line. So you can see that by right, resistance should be at the tip of this hold on, so normally it should be at the tip, right? However, we are putting it slightly above, so we can see the red lines, stop loss, slightly above, just slightly above the resistance level. And then we are looking at below at the major support area instead of resistance, sorry, that's a typo, major support area. We are looking at a support of the yellow golden color line, and then we can see that the take profit we did indeed put slightly above the major support area. Okay, that's one way to look at when you are putting stop loss and take profit. I mean, it's a very good guideline if you want to put it right on the resistance area, it is doable as well, or right on the support area, it is doable as well, depending on the situation of the analysis. So what is a healthy risk to reward ratio to have? Risk to reward ratio helps investors manage their risk of losing money from a series of bad trades. It is essential for traders to identify positive risk to reward. Typically, it's suggested to have 1 part of risk and 2 part of rewards. So 1:2 ratio. All right, very simple, just 1:2. Preferably if you can keep the risk down for a 2 part of reward, it would be great as well. But theoretically, 1:2 is a good ratio amount we are looking at. Yep, so here comes the hurdle. So a fixed risk to reward ratio could also pose as a difficulty for most traders. Something to consider in addition to risk and reward is the winning rate. So let's look at risk to reward ratio versus the winning percentage. So trading strategies win rate, let's look at 80%. So your risk to reward ratio will come down to 1:0.25. Meaning we are looking at sorry, it should be reward to risk, okay? So in this case, the chart is being plotted against reward to risk. So let's just say your winning strategy is at 80%. You are rewarding yourself at 1 part with 0.25% of the risk, and then so on and so forth, all the way to 20%. So let's just say your strategy win rate is very low at 20%. So you're actually exposing yourself to 4 parts of risk when you're only earning 1 part of the ratio or reward. All right. Oh, thank you, Juha, for telling me. Okay, so apparently the chat box is not working fine for everybody. If you guys have questions, you can put it in the Q&A box as well, I guess. Yeah. Okay, so let's move on. Okay, that comes to the end of this chapter on risk and reward ratios and leveraging. So we do have some time left, and I think it would be great if I share some live analysis, and it would be great if you guys wanted to pitch in to look at some pairs and we can analyze together. Okay, hold on, let me stop my screen. Let me just switch over to the trading view. I think I need everyone to mute the mic. Hold on. All right, hold on. Let me just share my screen real quick. We are unable to give WhatsApp line. If you guys have any more extra questions, I will show you a platform later on where you guys can access and ask questions. All right. So let's just hold that till the end. And let me share my screen right now. Okay. It'll be great if you guys can let me know that you can see the chart. Okay, I believe it should be sharing fine. Okay. Thank you. Okay, let's look at what we can see on dollar yen. We'll look at the weekly chart. Pretty good upward movement for a while. Looking at a potential further downfall. Okay, let's look at the daily chart. On the daily chart, I can pretty clearly see a ascending channel prior to the downfall. You can see that actually price has already broke out the channel. We are looking at a potential drop from here. Right now we are looking at a resistance, support turn resistance at price 142.078. Okay, on the daily chart, let's look at a 4-hour chart. I would say that on a 4-hour chart, the trend itself is not quite as clear. However, we are looking more of a ranging situation at support at 138.51. Let me just change this. Okay, and we have resistance at 142.078. So previously, price indeed dropped and did a little bit of a pullback, and we can look at a common V shape that we are looking at. I would say the overall day and weekly chart, we are looking at a downward fall. I would much rather analyze this to be a downward fall, looking at this and placing a nearer take profit. And putting a slightly above, just touching this, looking at a slightly above trade stop loss. This is how I am viewing it. We are looking at a potential sell. Let's take out the Fibonacci retracement. Closer to a 50% Fibonacci retracement for our take profit. And then let's do a smaller one actually. Yeah, looking at the sell entry at 50% Fibonacci retracement as well. Let's take out our we are also looking at a, sorry, this is wrong. Let me just take the 1.8% of stop loss. We can use this range, so we are looking at a bigger range for stop loss. We can also take a look at our and let's take a look at some indicators. Yeah, we are looking at a more likely to be downward fall. Let's take out our lagging and leading span. So price tried to break out of the Ichimoku cloud. We're looking at it to turn back down. So we are more likely to look at a potential drop. So classics are also looking at a potential drop downwards as well. It depends. All right. So we are also looking at a small upward channel. Okay. So if those that are concerned with this upward channel, you guys can wait till the price to actually exit the sale entry. I mean to exit the upward channel before doing any sale. So we can remove this 50% retracement and change it for a 38.2. And then if price actually breaks out of this upward channel, then we can confirm a better sale towards it. All right. So in this case, if you guys want to, you guys can actually put a closer stop loss to make it lesser than 1:2 part. All right. So this is dollar yen. Do we have any questions or any requests? Okay, so we can look at, starting from the weekly chart. Previously was a upward moving. All right, still upward moving actually, but looks kind of odd. Looking at something like this. Okay, we can look at a historical price level in March 2020. Looking at this to be a resistance level. However, our more recent resistance level, we are looking at 1.38821. Let's take a look at our daily. We have a clear sign of downward trend. And there was a certain pattern. This is what I have spotted on a upward trend. So let's just say if this is 100% accurate, then we will be looking at a downward fall. So around this area. So yes, indeed, it is a downward moving trend. So let's look at the H4. Can be seen as a channel, but not a very pretty one, I would say. However, we are still looking at a downward fall. Looking at a resistance level of 1.35355 to the most recent highest amount, we are looking at a general downward fall. I will not put my take profit to be 1.29862 because the price is a bit far away. Normally I do analysis that has a greater potential to complete in the same trading day. We are also looking at a forecasted entry that is a bit far away. It's a few bars away. So you guys can take into consideration and analyze it on your own POV. All right. Let's look at where should we place our stop loss. If I were to put it on this right shoulder resistance, it'll be too far away. It'll be 1:1 risk to reward ratio, which I'm not in love with. So I'm looking at a Fibonacci to help me out. So we are looking at a take profit at 78.6% Fibonacci projection. Take profit. This is a sell. And then let's take a look on how can we get our Fibonacci projection for Stop loss at 1272. So we are looking at using Fibonacci projection. We're looking at 1272% as a stop loss entry. As a stop loss entry at 1.36131. All right, so this is what we are looking at. It's sort of a forecasted sell entry, is a bit far away, but looking at previous 2-point touches, we are looking at this is to be a probable resistance level that we could be looking at. Then we can also look at a indicator. We're looking at a bearish movement right now for Ichimoku cloud, not very pretty. We can look at RSI. Also looking at a potential reach in resistance, and we are also looking at a downward fall. A very gradual one, but you can see that it's a downward fall. So this is dollar CAD for you guys. Okay, I'll be doing one last pair before I share the platform there. You guys can get in touch with us, and also a special Black Friday promotion. One last pair. Okay, let me think. We can do dollar franc. Let's do dollar franc. Let's do dollar euro. Okay, dollar euro. On the climb for dollar euro, you can see a very standard upward moving trend. Looking at a weekly chart, upward moving, not much of a key levels except for resistance at 1.0303. Let's look at daily. Previously upward moving trend has now dropped down. So we're looking on the decline side of things for dollar euro on the daily, and let's look at 4-hourly. 4-hour mark. Okay, so previously was a pretty steep downward channel. It looks like price has actually gone up a little bit, a fair bit. And then we can see a slight upward moving. If you guys really want to, you can do a very small analysis here. Just right below the support area. Let's use Fibonacci projection, looking at a 78.6%. Yeah, there we go. We have a 78.6 for the buy entry, and looking at 1.272%, which is 127.2. Looking at a stop loss over here. However, this is a very small trade. All right, so for fast and quick movement actually for euro dollar, let's look at some indicators. You can see the price is still struggling to actually break through the cloud. Okay, if you guys are fond of Ichimoku cloud, you guys can wait till price to actually exceed the cloud to take a movement. All right, whatever analysis right now I'm doing is purely based on the price action and not reliant on the indicators. Okay, so indicators are just supporting for me. So you can take a look at stochastics. Yeah, so we are pending the blue line to actually cross over the orange, so which is our percentage K to cross over our percentage D to have a better confirmation of a buy entry. Okay, that is for euro dollar. So let's move on to the VIP room. All right, so actually IronFX actually had partnership with our company to actually create a VIP room for you guys. Okay, so we are looking at a platform which allows you guys to actually interact with us on a daily basis to catch up on daily news, majors analysis, like we have euro dollar, pound dollar, dollar franc, dollar yen, Aussie dollar, Kiwi dollar, and DXY, which is your dollar index. Okay, so let's take a look at the platform. All right, so every day there will be important news that you guys can actually look at. There are forecasts that you guys can consider to take note in your analysis. So you can see that there are so many news for each currencies, major currencies on daily. So there's euro, pound, USD, of course, yen, we have the Aussie, Kiwi, and we also have commodities, which are our oil, as well as gold, which is a very popular pair as well when you guys are trading. So let's look at some of the majors analysis. So on a daily basis, we will also post analysis that you guys can consider and also discuss. So for example, I would like to discuss with him on this and or just want to ask on the page. So for example, let's take a look at let's just say I want to put in a Fibonacci for this line. Please for support. So I will say hi. With this people. So one special function that allows you guys to actually fully interact with us would be to link object to text. Okay, so I selected the Fibonacci extension with 0.786 lines and confirm, and I'll post. So once I posted it, if I hover over, you can see that there's a blinking red color Fibonacci line, as well as on your percentage line. You can see that, oh, we are able to understand what you're saying. So let's just look at some of their highlighted levels. You have the first resistance, the Fibonacci levels, second resistance, etc. So this allows you guys to actually interact and also look at our analysis on a day-to-day basis, which would be beneficial. And it's an open space, especially created by us and IronFX in partnership for you guys to actually have this exclusive website for everyone to interact and also look at the charts together. So we also have commodities. We have gold and silver. We also have your Brent crude oil, WTI, natural gas, and looking at soybean and corn as well. We also have your indices, your S&P, your NASDAQ, your DJI, your DAX, Nikkei. We also have crypto, Bitcoin, and ETH. All right, so we have our crosses as well, our special crosses that you guys want to see. It will be also available on this platform itself. So how do we get in? So normally, on the IronFX account, you guys' capital has to have a certain level. However, now it's on a 50% off. So what does that mean, right? So let's look at it. So for silver account, initially your initial capital in the IronFX trading site has to have $1,000. So now it has gone down to 500, 1,000, 2.5, and 7.5 for all of the different level and tiers of VIP account. However, starting with 500, you're able to access everything that I've been talking about over here. Okay, so you can look at, so some of the benefits will be exclusive market forecast, and then you're able to interact and ask questions about analysis. You're able to request market forecasts as well, personally to you. So just to take note, the Black Friday promotion will last from 21st November, 2 days ago, until 28 November. All right, the year has to be updated. Sorry, should be 2022. All right, let's look at so your access. So step 1, you just have to have a IronFX account and then log in to client portal and select VIP room. And then during the course of promotion, you just have to deposit enough funds to access the required account level of your choice. And then lastly, you'll receive a verification and proceed to verify your email to access the VIP room. Okay, so you can also click on this tutorial. So it will be shared on how you can access. All right, so I'll be giving this page to you guys on the chat box. Okay, so you guys can look at this. So can also share with you guys the website for that. All right, so you guys will be able to register from this website itself. All right, is there any last questions? Any last questions before I end the webinar? Oh yeah, for the attendee that was asking for the direct communication, this will be a perfect platform for you to have a direct communication, and best with a Black Friday deal of 50% in partnership and thankfully for IronFX. All right, so if there is no more questions, we will be ending today's webinar. All right, thank you guys so much. Thank you.
Hello, my name is Christina and welcome to another educational video. The terms mine and yours were used by traders on the trading floor to signal buying and selling of securities. The term mine was a buy reference while yours was a sign that an individual wants to sell an order. These terms were used with other similar terminology in the open outcry system. This system refers to the trading pits before 2010, where traders used verbal communication along with hand signals to convey trading information. In these marketplaces, large group of dealers and brokers engaged in competitive buying and selling. The words mine and yours were used to express the intention to buy or sell, respectively. Both buy and sell were also common. For instance, a dealer in the interbank market might type or speak mine to a counterparty of broker if they wish to purchase a specific currency. The trader will say yours, signifying it's yours if they were to decide to sell. In the same way, if a floor broker offered 100 call option as $1 each and a market maker decide to purchase them, they could respond by shouting mine to indicate their intention to do so. Both of these words were used to enable quick and precise transactions in a market that was frequently chaotic and active. Today, the words mine and yours are both still frequently used, mostly in the Forex market. Additionally, they continue to be employed in the same context as they did under the open outcry system. Thank you for watching.